We're Company G, and our case analysis is on Panera Bread Company. A little background about Panera Bread Company. It was founded in 1981 under the name Au Bon Pain Company by Louis Kane and Ron Scheich. Main locations for cafes were in malls, shopping centers, and airports. In 1994 through 1995, research in competitors gave rise to a change in company dynamics and a new company vision. In 1997, the company name was changed to Panera Bread Company, and convincings from Scheich paved the way for the sale of Au Bon Pain cafes and continued focus and investment into Panera Bread and the image of the fast casual themed restaurant. In 2011, 740 owned locations and 801 franchise locations operating worldwide. For the strategy for Panera Bread, they have a broad differentiation strategy. It values customer experience, stating that they want to be better than the guys down the street. Panera wants to be so attractive that customers will pass by several fast casual dining competitors and not think twice about passing them up for the Panera Bread down the street. Panera's menu, cafe locations, design, and ambience enable it to compete successfully in multiple segments of the restaurant business. Panera owns the blueprint for attracting and retaining customers called Concept Essence. This is achieved by offering an attractive selection of artisan breads, serving high-quality food at attractive prices, and to attract customers, Panera employs courteous, capable, and efficient customer service that complements a visually pleasing and inviting restaurant. Panera approaches growth strategy by opening both company-owned and franchise locations as soon as possible. And Panera's fresh dough proficiency delivers a competitive advantage. For the Porter's 5 Forces model, supplier bargaining power is moderate. For some products that are limited number of suppliers, for some products that are a limited number of suppliers capable of providing the quantity that Panera needs, but for some other products there are numerous suppliers. For example, antibiotic-free chicken has limited suppliers, but dough-making ingredients have numerous suppliers. Buyer bargaining power is high. There are a large variety of competitors with attractively priced substitutes, which make switching costs extremely low. Growth new entrants is moderate. New individual restaurants pop up and fail on a regular basis, but to create a similar nationally recognized chain would require serious capital investment and or an established network of franchises that would take a significant time to develop.
Continuing on with the Porter's 5 Forces, the threat of substitute products in the industry is high. Panera's niche is in providing lighter, home-style fare with homemade bread. Soup, salad, sandwich, and bread options are available from a variety of sources, including many sit-down restaurants and other franchise quick service providers. The substitutes are readily available, attractively priced, and of sufficient quality. The intensity of rivalry in the industry is extremely high. Panera Bread faces intense competition during breakfast hours from competitors such as Starbucks and McDonald's. Lunch and dinner competitors include chains such as Chili's, Applebee's, California Pizza Kitchen, Jason's Deli, Cracker Barrel, and Chipotle Mexican Grill. In the bread and pastry segment, Panera competes with Corner Bakery Cafe, Atlanta Bread Company, Au Bon Pain, and also supermarket bakeries. Driving forces. Number 1, adults seeking healthier food options at restaurants. In today's society, more and more people are changing their unhealthy lifestyles and starting to eat more healthy, nutritional items. 75% of adults reported in a natural restaurant industry study from 2010 to 2011 that they were trying to eat healthier than they did 2 years before. Patrons prefer heart-healthy, vegetarian, low-calorie, and or low-carb menu options to be available. Number 2, green movement, food grown in an organic or environmentally friendly way. Consumers are beginning to demand responsibly sourced food free of pesticides, hormones, antibiotics, and GMOs. In the same study referenced above, 60% of adults reported that they were more likely to visit a restaurant that offered food that was grown organically or in an environmentally friendly way. Number 3, popularity of locally sourced produce. Today, many restaurants are celebrating a farm-to-table dining experience. 75% of adults in the Natural Restaurant Industry Study were more likely to visit a restaurant that offered locally produced food items. Number 4, adults seeking restaurant loyalty programs. In recent years, a vast majority of companies have started offering loyalty programs to customers with a variety of different perks. 57% of adult consumers are more likely to choose restaurants that offer loyalty rewards. And the last one, economic recession forcing many to return to eating at home. Economic recession is also dangerous to the restaurant industry. Many families will often cut eating out from their budgets and prepare meals at home in order to save money in times of economic hardship. Even in a stronger economy, the average United States consumer eats 76% of their meals at home. Key success factors. Number 1, companies should offer a wide variety of health-conscious menu items and should provide readily available nutrition information such as calories, fat content, and sodium levels. Number 2, competing restaurants and cafes in the industry will need to offer certified organic produce or otherwise environmentally friendly options. Third, companies within the industry will need to establish partnerships with local providers of menu ingredients and advertise those partnerships to restaurant patrons. Made right here or locally grown should be communicated to the customers. Number 4, companies should establish a competitive loyalty program to encourage repeat purchases that offers discounts or free products. Research may be necessary to find out what specifically is important to patrons of each company. And lastly, in order to compete in the industry, restaurants will need to offer a variety of menu options at multiple price points to allow entire families to eat out at a reasonable cost.
SWOT analysis. A strength of Panera is the company offers health-conscious offerings with whole grains, antibiotic-free chicken, unbleached flour, etc. This is great because with most consumers in today's society, they're eating healthier, more nutritious items. A weakness of Panera is Panera franchising agreements. Panera franchises are expensive and carry rigorous criteria that may make it difficult for prospective restaurant owners to invest. There are 8 stringent criteria that have to be met before they can franchise. Experience as a multi-unit restaurant operator, recognition as a top restaurant operator, net worth of $7.5 million, liquid assets of $3 million, and infrastructure and resources to meet Panera's development schedule for the market area, real estate experience in the market to be developed, total commitment to the development of the Panera Bread brand, and a cultural passion for fresh bread. Panera also reserves the right to terminate franchise agreements and to develop its own company-owned location or a new franchise in that market, making their franchise sometimes a risky investment. An opportunity for Panera would be the offering of certified organic products made from locally sourced ingredients to satisfy changing consumer taste and preference. The quick service restaurant industry is known more for unhealthy fast food. Brands that differentiate themselves on the basis of the green, healthy movement could reach new markets where quick service has traditionally been unpopular. A threat for Panera is extreme competition between companies that makes the restaurant industry volatile and risky. Industry members often seek many ways to differentiate themselves, be it through pricing, food quality, menu themes, signature selections, dining ambience, atmosphere, service, location, and convenience. With so many independent and chain restaurants already competing, it can be hard to find a new method for differentiation and difficult to find a foothold in the market. On to analysis of financials. Historically, Panera's return of assets and gross profit margin have held relatively steady in spite of their economic recession in 2008, which hit some members of the restaurant industry hard. Panera's return on equity did decline during the 2008-2009 economic recession, partially due to the recession, but of course also from the impact of significant investments in domestic and international expansion. As shown in the graphs, Panera has managed to maintain a relatively stable position since the recession, 2009 through 2011. Since the vast majority of locations are franchised, Panera has been able to maintain the attractive return of equity, return of assets, and gross profit margin percentages through consistent revenue streams of franchising fees. The consistency shows that Panera is a financially healthy company that is capable of competing with fast food chains and other sit-down restaurants.
For the managerial worry list, top concerns for Panera's management team are 1, choosing whether or not to move forward with opening more nonprofit pay-what-you-want bakery cafe locations. There are currently 3 locations within the United States. Number 2, how to continue the distribution of fresh dough to bakery cafes. No chemicals or preservatives are used in any of the bread or bagel varieties, and the dough is never frozen. Number 3, the growing popularity of locally sourced ingredients among restaurant patrons. 75% of adults are more likely to visit a restaurant that offers locally produced food items. Number 4, high cost and rigorous criteria of franchising makes rapid expansion difficult. With a franchise agreement difficult and expensive to obtain, few investors are able to partner in growing the Panera brand. Number 5, extreme competition in the restaurant industry makes it necessary for Panera to protect brand integrity and maintain a differentiated market position. Our recommendations for Panera, number 1, we believe that they should close the nonprofit pay-what-you-want locations as they do not contribute to the overall success of the brand and are a distraction for corporate management. As noble as the cause may be, these cafe locations are in wealthy areas, which is probably not much help to the impoverished people that they are attempting to serve. It is also more likely that those who underpay at these locations are simply taking advantage of the system. These locations also do not contribute to the bottom line goal of the business, which is to generate value for shareholders. Panera management should focus instead on initiatives to donate leftover bread to homeless shelters or donating a portion of profits to causes that feed the hungry. These acts very simply would meet the social responsibility goals that Panera is attempting to achieve with the nonprofit locations, but without the significant investment in leasing a location and purchasing extra supplies. These existing locations could easily be replaced with the traditional profit-driven bakery cafes to refocus corporate attention on running a business and making charitable contributions in other ways. Number 2, we believe Panera should start making dough in the individual bakery cafes, as it is costly to distribute fresh dough on a daily basis to all company-owned and franchise locations. Since the dough has no chemicals or preservatives and is never frozen, it can be expensive to make and quickly transport the dough using temperature-controlled trucks. The volatility of gas prices can also play a role in driving up costs. Since Panera relies heavily on franchising, the investments and equipment necessary to make and store the dough throughout the individual stores during the process could be included in the initial investment the franchisee makes in the location or property for their store. This would alleviate costs for Panera corporate, instead passing those expenses on to individual franchisees. Making the bread within each bakery cafe could also be advertised as made right here, which contributes to an image of local sourcing and sustainability. Panera already has a reputation for providing healthier and more environmentally friendly menu options than their quick service counterparts, and an element of local sourcing would help solidify their differentiated position as food you crave, food you can trust. Our last recommendation for Panera is that they ease the criteria for franchising with the brand. While it is necessary to maintain some guidelines to ensure quality franchisees, Panera's stringent checklist makes it difficult for investors to enter the notoriously risky restaurant industry. Franchisee applicants must have such a significant amount of capital to invest in not just 1, but typically 15 locations, that many turn away in favor of less expensive franchise alternatives. Sometimes this may be a positive in terms of garnering serious commitment from the brand from franchisees, but it is also a serious deterrent to nationwide expansion, as many franchisees simply cannot afford to partner with Panera. Panera should maintain the right to terminate franchise agreements for quality control issues, but their stipulation that they may revoke a franchising agreement when a franchise fails to develop bakery cafes on a schedule is a double-edged sword. When Panera revokes these agreements, it essentially creates competitors for itself, as these locations will almost immediately rebrand as another bakery cafe if Panera does not repurchase them. In this scenario, Panera must start from scratch in those markets. Between 2010 and 2011, Panera revoked or repurchased more than 122 of their bakery cafe locations, amounting to about 8% of their stores nationwide. This turnover may be eased by setting more realistic expansion goals, like 5 stores per franchisee rather than 15.